It's time now for a check on the stock market action here and elsewhere. I have Professor Yang Jun-sok at the Catholic University of Korea live on the line. Professor Yang, it's good to have you on.
Happy to be here.
Right, Professor, Wall Street ended mixed last week amid strong data on wages. The Dow Jones rose 0.1%, while the S&P 500 and the Nasdaq surrendered 0.12% and 0.18%, respectively. What is your assessment, Professor?
Okay, even though Friday's numbers were mixed, for the week, Dow gained 0.2%, S&P by 1.1%, and Nasdaq gained by 2.1%. So overall, the stock market was doing very well. The gains were probably from Fed Chairman Powell's Brookings Institution speech when he said that the rise in interest rates may be slowed in the future because of the potential of the interest rates not rising as quickly. Tech firms are taking more advantage of this situation than traditional firms. But the market does seem to be downplaying other elements of recent Fed announcements where they say that the peak interest rate may be higher than expected, and the increases in interest rates may come over a longer period of time. We expected the peak interest rate to be 4.75% in September, but now it looks like it'll be 5.0 to 5.5%, and maybe even higher. And previously, the peak was expected very early in 2023, but now it seems like interest rate increases may be taking place throughout the first half of the year. The U.S. inflation is slowing, but it's still very high. Labor market is also slowing, but it's still unbelievably strong. Payroll report came out on Friday, and that's partially why the indexes were mixed. But the U.S. payroll rose by 263,000 jobs. Wages rose by 0.6% for the month and 5.1% over 12 months. So even though that is not keeping up with inflation, it is still very much higher than the inflation goal, Fed's inflation goal of 2% would require. Unemployment rate is now steady at 3.7%. That is much below what the American economists think of as the full employment. Job opening and labor turnover report also came out late last week for the United States. And job vacancies are coming down, but it's still at a higher level than it was in 2019 pre-pandemic. Thanksgiving seasonal sales numbers so far seem very strong, thanks in part to large discounts by stores trying to get rid of their inventory. So overall, even though inflation seems to be coming down, U.S. is experiencing a very strong economy. That means interest rate is likely to continue to go up for the foreseeable future, and that accounts for the mixed figures on Friday. Year to date, Dow is down 5.9%. S&P is down for the year by 15.1%. Nasdaq is down for the year by 27.6%. Asian markets today, Nikkei, Shanghai, and Hang Seng are all up. The reason is due to China loosening up its zero COVID policies, even though it still maintains a harsher zero COVID policies than most other countries. It is loosening up, and that seems to be giving some optimism to Chinese investors. The yuan is strengthening as well. The European market, it's just opening today, but Friday, DAX was up, FTSE and CAC was down. The European Union has tentatively agreed to price cap for Russian oil at $60 per barrel, but Ukraine is complaining that will not be enough to really choke the Russian oil exports, because revenues from Russian oil exports, because it is too close to the market price. Germany October exports fell more than expected at 0.6%, but trade surplus increased as imports fell by 3.7%. Germany is expected to go into a recession, but the recent data, not only trade but also growth, which showed 0.4% growth quarter on quarter and 1.3% growth annually. There's some hope now that recession in Germany may be shallow.
Right, I see. Meanwhile, back here on the local front, Professor Yang, the local bourse started strong on this Monday amid expectations, like you mentioned, of a possible ease in COVID-19 restrictions in neighboring China. Professor Yang, what are your thoughts about the performance on the domestic front?
Okay, well, last week, Kospi was down by 0.14%. Nasdaq, again, for the week, last week was down by 0.8%, and Korean won appreciated by 2.39%. But today, the optimism on China's loosening of zero-COVID policy seems to be playing into optimism. But on the other hand, the possibility of U.S. interest rate rising seems to be playing off some pessimism as well. Today's market, Kospi fell by 0.61% and ended today at 2,419.36. Individuals bought, institutions and foreigners sold. Nasdaq went up by 0.05%. It ended today at 733.32. Individuals again bought, institutions and foreigners sold. So again, there's optimism on China, but perhaps some concerns about U.S. rising interest rates, which is making foreigners sell off their stocks. For the month, Kospi went up by 2%, Nasdaq by 4.7%. Year to date, Kospi is down 19.1%. Nasdaq is down 29.3%. The Korean won appreciated today by 0.88%. So now it's 1,294.50. And if you look at the last month, the Korean won has depreciated by the Korean won has appreciated by 7.8%, and that is generally consistent with other major currencies like Japanese yen, British pounds, and the euro.
Right, and beyond the stock markets, Professor Yang, Korea's consumer price accelerated 5% on year in November, and this pace is said to be the slowest since April. What are your prospects regarding these prices as we head into the new year?
Okay, well, the Korean consumer price index inflation is definitely on a downward trend, and it fell more than what I personally expected. Last month, it was, on October, 12-month headline inflation was 5.7%, but that came down to 5.0%. But perhaps even more importantly, if we look at inflation just for the month of November, the prices actually fell. There was a deflation of minus 0.1%. And if you look at core inflation, core inflation without agricultural goods and oil, the 12-month rate was 4.8%. Core inflation without food and energy was 4.3%. But again, the important numbers are not over 12 months, but on monthly basis. For the month of November, the core inflation without agricultural goods and oil came down from 0.6% in October to 0.3% in November. And core inflation without food and energy came down from 0.4% in October to 0.3% in November. So the inflation seems to be at least somewhat getting back into normal, though we still have a long way to go. Much of the fall came from rapid decline in the prices of fresh food, which is good for households. Also, it was helped by oil prices. Right now, the West Texas Intermediate is about $80.50 per barrel, and even though the OPEC Plus has been trying to cut supplies and raise prices, the prices haven't really been going up, so that's been good news for the Korean as well as global inflation. The Bank of Korea has said that it expects high inflation to continue at 4 to 5% range until early next year. I generally agree, though I think it'll be more of a 4% range than 5% range. But one worrying aspect is that manufactured goods inflation is still a bit too high. Over the last month, it was 0.8%. So there is a momentum behind inflation, and the going from the current 5% to the target of 2% may be a lot harder than we expect.
Right, I see. Well, I see. I suppose that is, we'll have to wait and see then. All right, Professor Yang, as always, thank you very much for your time and your thoughts.
Thank you.